Welcome back to Rockstock Channel. It is Sunday, September 15th, and Rodney and I are here to talk about, the catalyzing, a lithium stampede, CATL in China. That was the news of the week, but there's a lot of things that we want to talk about, but, figured we'd just record here on a Sunday. Since our last Rockstock recap at the end of August, we're now back to school here in the Western Hemisphere, and a lot of things are happening. Benchmark Minerals had their Perth event. There's lots of conferences, webinars, investor days, and site visits. I'm heading back to Quebec. Sayana's having a site visit, as is Winsome, Patriot, and Arcadium. Arcadium's having an investor day this week in New York. I'm also going to see that. SC Insights had a webinar last week, which I'd encourage you guys to watch the video for that. Our friends Andy Leyland and Jose Hoffer. There was a presidential debate. I was thinking kind of Pink Floyd Animals was kind of the takeaway there, with dogs and cats and pets. I also joined a lithium-ionic lunch. And, so Rodney, we were talking last year. We were all talking structural deficit, is here to stay. Obviously, we backtracked on that because supply has been a lot faster than we expected. We've talked about that a lot. But is the demand thesis still intact on that argument? And if so, it's a question of demand catching up with supply, or maybe this supply cut, which again, it's murky speculation, rumors, on CATL. It's hard to kind of get a sense of it, but a lot of analysts have commented about it at brokerage firms and the like. Some more positive than other, and some more negative. Goldman was quite, still pouring cold water over it, which we could, flash up here. But what are your thoughts on the CATL news in particular, and the overall demand thesis versus supply for lithium?
So my demand number is still the same. It's just there's been a bit of moving chairs on the top deck there. China's EV sales are exceeding my previous forecasts, and the US and Europe have slid a little behind. So Europe cut away subsidies, and I guess the truth is told, when you're selling expensive and limited a limited choice EVs in Europe, the demand isn't quite what it was, and they are now sort of trying to push back on Chinese imports, although China's going to set up factories within Europe. And now the talk is that a collection of the OEMs are going to try and push back on 2025's, the carbon emission standards for Europe. They're going to try and push back on that time to avoid the penalties. So Europe coming in a little light, the US coming in a little light, the rest of the world is as expected, and China ahead. So my forecast is still above 3 million tons for 2030 because I've been outlier bullish on ESS. That's now playing out. You're seeing renewables being put everywhere, renewables plus battery for the grid. That's growing fast. So I still have quite a high number of the ESS relative to EVs, or to broadly to transport, the battery demand. So my demand number hasn't really changed much. One of the adjustments, of course, is with China being a higher percentage rather than the US and Europe, is LFP taking a bigger slug, which has less scrappage at the battery plants, less lithium in the cathode or whatever. So there is a little bit of lithium intensity drop, and also a higher yield at the battery plants. So that is affecting, usage, although it gets recycled, but in the immediate demand, drops a little because of that. And you probably also have slightly less on the inventory side. So it has a sort of short-term adjustment from the CATL perspective. It's interesting because we know that in all likelihood, CATL was using its own material as vertical integration and keep prices down for the rest of what they buy. So if they're prepared to switch off hard, they must assume that the price or whatever is not going to move so materially that they can still buy up what they need at a good price or at similar prices. So I think we're going to move up the cost curve, but if this is going to make a material adjustment to prices in the short and medium term, then I still feel that more volume needs to come off. And the question is, what are the balance sheets of the producers look like that are now next in line with the cost curve? So, is MinRes slightly overexposed because iron ore is coming off at the same time as lithium, and they've raised quite a lot of debt? Is Mount Marion at risk? Could they cut back, or some of the others, because they don't have the balance sheet that they used to have, that kind of thing. So it's always hard when you're assessing Chinese producers, because we don't have a good handle on Chinese state-owned banks, what kind of subsidies they're getting, how long can they last. But the CATL, if they are suspending, that is positive. And now, but from my perspective, looking at 2025, even with the pushback, we've got brines in Tibet and other projects coming online globally. I feel we need to see another 100,000 tons of effective supply come off the market if we are going to see a meaningful move higher. But we could. I don't disagree with what the guys are talking about, 13, 14,000. It's kind of 90 to 100,000 renminbi. We're not seeing that on the GFEX. The GFEX is still mid-70s to low 80s on the forward curve going out to the end of next year or early 2026. So we haven't seen that move translate, and we've not seen the spodumene price move up either. And Howard, as you know, in Q2, Greenbushes and others showed an achieved price of over $1,000 a ton for their spodumene in that quarter. So the lower spot price has still got to translate through into the financials now in Q3 and possibly even Q4. And then we'll have a good opportunity to assess how profitable is Pilbara, how profitable is Sigma, and so on, the more they reflect an achieved price closer to like a 750 spot.
That's lag effect, in the financials. Okay, so you're saying that the spot price hasn't yet reflected what, we saw with the CATL news being reflected in the equities, which look like short covering, very quick short covering reaction. Some of the brokers, I think UBS or Citi, was talking about 20 to 25% upside, to the spot price based on a presumed CATL, taking out 5,000 to 6,000 tons LCE per month, if it was kind of completely turned off, which is an if we don't know the answer to. And also another if is how fast could they turn that back on? If they turn it off and we have a 20 to 25% rise, how quick can that come back on? Do you have any line of sight of that?
So again, that's the debate as to what the price is, and I see various commentators come through. So the GFEX jumped, I think, about 8%, but as I said, it's sort of slightly above mid-70s, and contango up to low 80s going out. So we haven't yet seen that 20 to 25%, and that will translate, I guess, into as that shuts down. I don't have a good handle on how long it would take CATL to come back online. And then the question is, Howard, I guess it's like, with Aussie producers or other producers, is how much of a buffer do they want to see between their cash cost and the actual price before they get people back on and mobilize and refire up into production? Because certainly in the Western world, you'd want some kind of headroom between, before you send people back out and make the commitment to restart mining. So that's an interesting question. I certainly said 90, but I would say definitely by my gut says at 100,000 renminbi, they would probably be back out there.
Okay, and what's that in dollar terms?
14 give or take.
14,000. Okay, so that's still not like incentive pricing in the West, which we think is kind of 20,000. So you think
Look, I mean,
okay,
there's guys who have a different view on they think that CATL is kind of higher, but as I said, we know there are brine projects in Tibet and elsewhere coming online, Howard. So the question is CATL taking a view that there are other projects coming online? There's brine and there's, I don't know, where, I mean, Goldman's numbers were, sobering, looking at their production volumes for 2025, because they're pretty hefty. They're certainly higher than mine. So would they be prepared to, even if their operating costs are slightly higher than that, would they be prepared to operate back again at 100,000 and absorb a slight loss if that is the case? Yeah, probably.
how much supply could come out of China is a big question. I listened to our friend Joe Lowry's most recent podcast with a guy from Hatch, and he asked him the question about how much supply out of China from Chinese ores, right, or brines, and he said 300,000 tons LCE max. I don't know what time frame he was talking about. I don't know if that was a this year number or a future year number, but the Goldman number, that they already have them at 380,000 like now. So
and next year is like double that, I think.
Yeah, exactly. So and that's including the brines that you're talking about, not just lepidolite, right? Because no one has really line of sight on the brines and what's happening there. So Goldman, which will flash up here, has insanely aggressive numbers for Chinese spodumene, lepidolite, and brines, which seem, I haven't seen the underpinnings of what's behind that, but we'd be remiss not to pay attention to Goldman, because everyone dismissed Goldman 12 to 18 months ago and said they were insane to think that lithium was going to, get to 11,000, and now it's below, 11,000. So it overshot. Goldman was wrong. They were too conservative on the downside. So
yeah, look, where I disagreed with them hard, and I still do, is they have this sort of long term, and so does, I think, Morgan Stanley, bumbling along at 10 for a number of years, and I'm saying no. And what we're seeing now is we've touched it, and immediately CATL has responded. So I'm saying I don't believe that you can, on a long time frame, have 10, 11,000 as the price, because people are going to fall by the wayside.
And you can't have those supply numbers if the price is that low. But I think Goldman is not 10,000 for that far into the future, but they don't get Stanley, very high. I think
they had it for like 4 years or something, which I think is just...
Okay, but there are others out there. UBS had a note out there, and Canaccord on African supply. There was some debate there. They had, same trip, different takes. Do you have a comment on that?
Yeah, so it was interesting. So when I looked to UBS, the number was between 500 and 750 CIF China, which is like extremely competitive. I hear different numbers, and certainly in terms of the cost of the logistics and so on. But, it raises the question, we also saw some cost curves, Howard, on Australian and other producers, when you take corporate overhead and exploration spending and what have you. And that is the issue that I raised at 1-to-1 mining last year, is when you throw all those things in, 1,200 is kind of the number. Now, I guess they can trim on some areas there, whereas a lot of the Zimbabwe, some of it's integrated. So they don't have the massive overheads. They don't do the exploration. They can run leaner. I mean, 5 to 750 sounds low, but the point is, could we see Brazil, Zim, whatever, displacing some of the more expensive, higher corporate overhead, maintenance, sustaining, exploration costs of Aussie? But, I think, again, I don't think 750 is a number that can last for too long. And I would like to think that we would see, when you see the Pilbaras and Sigmas and Mount Marions and whatever release their financials, if 750 sits for some time, then I think I cannot believe that they wouldn't adjust their production profiles.
Right. Okay. I hear what you're saying. So I agree with you, right? If they're not going to continue to lose money, that they shouldn't want to continue to lose money.
Well,
And
once you've
to
factored
deplete.
in all costs and run it through and you see a negative cash flow on it, I don't think that shareholders would be supportive of just simply mining for the sake of standing still.
Exactly. And you have a depleting resource. So
Yeah,
it's
exactly. And the grade
to
is,
lose.
they're not mining the low grade stuff from what I see
Right.
through the head grade of what gets processed. So it wouldn't make sense to me. As I said, they've been showing the numbers on over 1,000, but as we converge on the 750, and whilst the CATL news did move things, I mean, you will know as well as I do, looking at the charts, there's some quite eye-watering numbers on short positions in a lot of these shares.
Absolutely. I didn't actually see all the volume, but on Pilbara, 20% or 21%, I think, versus the volume to cover all of that, or even cover half of that, would take probably 2 weeks to a month of consistent buying. So you saw those shares rally aggressively for 2 days, and then even a third day it was still up. Some of the other shares fell back down, like Albemarle and Arcadium, after 1 or 2 days. This is a Australia-dominated phenomenon. I mean, Australia has always been smarter and faster in understanding and looking at what's happening and reacting to what's happening in China, and the Aussie shareholders in that. So, and to some extent, obviously the Chinese as well. I think Ganfeng and Tangxi were limit up on one day.
They've
In
drifted
IGO,
back down now, which is interesting.
yeah, yeah. So I think it was a short covering rally, but it's also the news is not definitive out of CATL. It's very murky Chinese, like, it's not like transparent. It's not like Chris Ellison or Kent Masters out there saying explicitly what they're doing. It's a few brokers who got wind of something, and their channel checks. So it's very still uncertain. The IGO headline that I saw, I didn't look at the whole presentation, but he basically said something to the effect of, like, you need to embrace the volatility. Lithium is going to need 80 projects of 20,000, equivalent LCE over the next decade. He sees a tripling, like you see a tripling, over the next decade. You're arguing it's as little as 5 years, which is an extremely short amount of time. But those who have embraced volatility, as we've said before, lithium has been the best performing, commodity for 4 of the last 10 years, and the worst performing. So if you buy at or near the bottom with a 3 to 5 year view, even if we're not at the bottom now, it would seem that there are great opportunities to be buying stocks now. And you were arguing in our last Rock Stock channel that a lot of companies are trading at well below their replacement value. Since that presentation, I was sent a note that Citi wrote on Rio, suggesting that they should buy Arcadium. Arcadium is trading at 2.9 billion market value and don't have very much debt. And Citi was arguing that to replace today what Arcadium has would cost about $8 billion. So by 2030, in a conservative case, they should be producing 150,000 tons, of LCE. So there's not a lot of greenfield opportunity. And they were comparing it to kind of Jadar, which was like a 58,000 ton production project, but it would cost $3.5 billion. So if it's going to cost $3.5 billion to build a greenfield for 58,000 tons, and by 2030 you could have 150,000 tons. So they were making a very strong and compelling argument that Rio should buy Arcadium. I'll also, fun fact, Lithium America's Thacker Pass, the capex is $2.9 billion, right? So Arcadium, or a project, right, that still is not yet, fully funded and would take several years and a lot of technical risk to kind of get in place. So there are great values. If you close your eyes with a 3 to 5 year time horizon, it's very easy to see how an Arcadium could double, if not more, and maybe a lot sooner than in 3 years. So I'm looking forward to the Arcadium Investor Day later this week. I'm going to attend that, but I'm also thinking, if you're looking beyond a company like Arcadium, if you think Arcadium can double in a 1 or 3 year time frame, to buy a more risky development company, you have to be looking at 3 or 5 times upside, within that time frame. And I think there are examples of companies like that. We're examining them, but like there's still this dilution risk is overhanging a lot of companies. Like, how much cash do companies have? How long before the cycle turns here? One takeaway, I went to this lithium-ionic lunch on last week, and it was very soon after, Pilbara bought Latin resources, and Brazil we like, just in terms of, Brazil we like because you could have competitive tension between China and non-China actors, but also just pure spodumene companies where you're not worried about doing downstream. A lot of the Quebec companies, there's a freight differential disadvantage. It's hard when you look at them. You need to think: is it just a spodumene play, or is it going to be a spodumene plus, downstream? And downstream's complicated. In the case of Brazil, you could look at, or Africa, and like Atlantic Lithium's case, you could look at these as just as, low capex, low opex, sell to China spodumene. But lithium ionic is like an 80 million market cap. And Latin got bought for $440 million. And then you have Sigma, I think, is trading at $1.5 billion. And then Pilbara is trading at, $5.5 billion. So, and then I compare that to kind of Fortescue, along the lithium versus, iron ore chain. So like, again, lithium ionic at $80 million, is that below replacement value to kind of replace, and here, this replacement value argument is, it gets to like M&A. Again, can be a catalyst to this market before prices start rising. What will generate more kind of excitement, in lithium land? And that was just, an example.
That's a good point, Howard, and it's the one that we discussed last time on the Rockstock recap. Is it doesn't really matter where lithium is. It's what's relevant is what is the effective price embedded in the price of equities, and how does that relate to your view on a long-term price through the cycle? That's what matters. So when lithium was $80,000 a ton, what mattered is what was embedded in the price of equities at the time. And now we're at a point where lithium is low. We've seen CATL make a move, we think, and trim back production. So if you've got 10,000 or 11,000 in your model as the long term, we're saying we don't think that's an appropriate number. The debate, of course, is what is an appropriate number, and I'm sure Rios or whoever would run the ruler over Arcadium and say, where does this all make a lot of sense? And again, to the discussion we had is, a proper run in the lithium price is going to happen when the marginal cost producer is an ex-China greenfield project. Now, the nub of the debate is, can Zimbabwe, can Brazil, can China lepidolite, all of these things backfill into 3.2 million tons by 2030, and can they do it consistently? Will the grade, have they got the size? Is there going to be an ESG issue? infrastructure, transport, all those kind of things. We live in a very volatile geopolitical world. That's the question. And the larger the demand number gets towards that 3 million and bigger, the more risk there is that there's a breakdown in the chain. So one of the things that appealed to me when I looked at lithium versus, say, oil is if you look at the characters who belong to, OPEC, it's, the who's who of the rogues gallery. Whereas lithium was, when we started our business, was more Australia and wherever else. Now you're getting some more interesting jurisdictions that could have some logistic hiccups, as Ganfen goes into Mali, as you expand. I mean, Zim, I guess they go through South Africa or elsewhere, but again, you're dealing with jurisdictions and governments that could throw a few curveballs in it, which is going to make it, more risky. So the profile of producers is different than what we thought.
Yeah. In Africa, I'll make a comment. SQM made another investment, early stage exploration into Andrada, which is in Namibia. This follows SQM over the summer making another exploration investment in Sweden through Tolga, but they had good luck in Azure. But if you look at SQM strategy outside of, just growing Atacama as fast as they can, they invested in Kidman, Mount Holland, then Azure, now Sweden, now Namibia, all spodumene hard rock, right? This is after they dabbled with LAC, way back when, but they're not interested in Argentina. They don't seem interested in DLE. They're not interested in clay. They haven't yet ventured into hard rock in Quebec. I would think that would be an opportunity for them. But what do you make of SQM's preference for hard rock, and what do you think about? Well, I don't know. We haven't really examined the Andrada, Namibia thing, but
look, I mean,
what do you think about SQM strategy?
It's driven specifically by technology, but what they have done is they've done astute deals in terms of pricing, Howard. They've bought, when they did the previous, hard rock acquisition in Oz and the other ones, they've done it at great pricing.
They never overpay.
No, I mean, they've done commercially good transactions. So would an SQM participate in a Rincon? No chance, I don't think.
No.
They understand, especially from where they are. So I don't know that there's a particular preference to flow sheet versus what makes the economics. And they must have a fair understanding of the challenges of DLE, given that they assess their own brines. So again, it's a pricing thing. So I guess they're sticking with the more conventional flow sheets, and
these aren't big investments. I don't want to overstate.
I've forgotten the name. The one they did in Australia,
Azure.
Yes, that is that's a crackerjack deposit as well. It has some phenomenal drill results. So
it is, and so they're astute at finding and buying at decent prices, but they do have a preference for hard rock. It seems, because Mount Holland is a big project, and Azure is going to be a big project. These ones in Tolga and Andrada, it's early stage exploration. It's not a huge dollar commitment. It's exploration risk. We shall see, but we just thought we'd bring it up as relevant.
Q2, so they have, hat tip to SQM. They've done very commercial and astute deals.
Yeah. Well, maybe who knows? They'll come into Q2 Metals or Winsome Resources in Quebec. Clients of ours or guests that we've had. Q2 has had very good further drill results. I think they put out a 300 meter intercept.
397 meters.
Okay.
And it was at a good grade. So, I mean, could we have another 100 million ton deposit on our hands there? It looks like it.
Yeah, we'll see. I think they're another interesting story. I think but it also speaks further to Quebec as a jurisdiction. I think the more high grade deposits and big discoveries over 100 million tons that are found, the more attractive the province is as a region. And if we did have M&A in some way from Rio Tinto, I think Quebec needs a West Farmers like entrant into it to put it more firmly on the map in the way that West Farmers and SQM did in Mount Holland.
Howard, you always make the point about Rio's with, is it aluminium there they've got?
Yeah, I think there are 9 or 11 aluminum refiners and smelters in alumina and I think aluminum in Quebec, and half of them are Rio Tintos and the other half are, I think, Alcoa. I want to make a comment like outside of lithium, because at the 121 conference in New York, I put out this table and I called it like invest in anything but lithium, ABL as a ticker symbol, anything but lithium, as of May 31st. If you look at gold proxies, copper, uranium, aluminum, oil, steel, iron ore, everything had done well in the year up to May 31st. So I looked up what's happened since then, and everything other than gold has done badly. So the COPX, the copper ETF, is down 14% the last 3 months. Uranium down 21%. PIC, which is a broad-based, that owns Rio Tinto, BHP, and non-gold mining, down 13%. Alcoa and aluminum down 27%. XLE, which is an oil, down 8%. Nucor, which is a steel company, down 15%. FMG, iron ore, down 29%. And only gold was up 13%, or GDX. And Albemarle and SQM as the lithium proxies, they were down kind of 29 and 18%. So as bad as lithium is and has been for the past number of months, everything else other than gold has been bad. Appreciate your comment on that, because I know you've been studying a lot what's happening in China broadly. That's been influencing, I think, a lot of those other commodities. And you've also been doing some work on, government debt and the dollar and other things, which could be influencing, the gold price. But before responding to that, Rodney, a number of analysts who we've looked at or on Twitter who we know, like the Gehring and Rosenzweig, fund managers in New York, or Marin Katuza, they both have argued, as has Frank Justra at the Precious Metals Conference, that commodity equities have never been cheaper relative to other equities. So they have charts of the S&P index, or the S&P commodity index versus the S&P 500 index, or the Goldman Sachs commodity index versus the Dow, both of which are just showing an extreme undervaluation. I looked at when I was trying to figure out what's an appropriate valuation of Pilbara, or Arcadium, or Rio Tinto. And you look at Rio Tinto trades at 5 times EBITDA, right? That's just a really low valuation, and the PEs are 10. The traditional metrics that one uses for other businesses, just seem very cheap. So this just made
Howard,
it. Yeah.
The point to make there, though, is the big earnings drivers within Rio are all in backwardation. So the assumption is your forward PE and your forward, EBITDA is going to be lower, because iron ore is permanently in backwardation, and some of the other commodities. So everyone's assuming that the price is going to drop, so they're going to make less money.
Right. Okay.
But I guess broadly speaking, we touched on this a little bit last time, is, China, the days of 10% growth are gone. Now they're sort of struggling to hold on to 5 as they go through a property a nightmare. If you look at the numbers there, it's quite hair-raising. They're looking to do some stimulus and adjust, but that's going to have a very negative impact, hopefully, as part of the whole geopolitical. So, I mean, Howard, I'm sure you're aware, it's more closer to my neck of the woods because South Africa was part of BRICS. They're trying to do a de-dollarization and create a separate unit of currency, and they're talking about like a blockchain-linked digital currency, and it's possibly backed with 40% gold, and then a whole basket of currencies coming in. So, there's sort of a whole lot of bigger movements afoot, and part of the sort of spillover of that is you've seen Western OEMs market share in China in the auto market just in free fall. They've gone from literally, 2/3 down to 1/3, and they're basically getting wiped out as China moves to EVs. And there is a sense of, I don't know what you would call it, but nationalism or patriotism in buying domestic cars. So it's having quite a lot of effect. But the property market has that's caused the iron ore wobble because there's a lot less demand for steel. But at the moment, from a lithium perspective and from a demand perspective, it seems like China is hell-bent on pivoting to EVs and pivoting to domestic EVs. And some of the shares, NEO had some quite good results. That share's held up, XPeng or what have you. And then the other is renewables. So at the moment, just looking out a little bit, it looks as if that demand will remain intact because China is converting. And then I tweeted, if you remember, I saw, NEO was talking about like 70 to 80% EVs by 2028 or something. So, it's just astounding how quick this has been. And it's astounding how quick they're going to renewables. And that's affected the coal price because they're putting in, solar in particular, and then wind at an incredible rate. And that is going to underpin a lot of ESS, I think, and the same, for the US, although the US is mostly driven, I understand, by, I think, Texas and California. So at the moment, there are some economic headwinds in China that cause me some level of concern, and it looks like there's deflation there. But the push into batteries and into renewables and into EVs means that the rate of EV adoption in China is exceeding my models. A possible boost, something you haven't raised, I know you like to talk about, is the whole Tesla, this Robo taxi day, because if Tesla has cracked the code on self-driving cars, there is a window and a period. I mean, if you think about it, that should mean a big boost. And my understanding is they have production capacity of about 3 million cars, give or take, where we are now. And I guess that could grow, but they're a bit below that. So, could that be a surprise boost to EV sales in the US and possibly elsewhere? Maybe.
Well, that's what I've been flagging and hoping for. They moved the day from August to now October. I saw Steve Mark Ryan had a video where there was, a picture was released. The Robotaxi unveil day is supposed to be at the Warner Brothers studio lot, in Hollywood. I'm not exactly sure the reason for that, but he showed what looked to be a 2-seater car. And a lot of the thought is that Robotaxi, that would be just 2-seater, because most Uber rides are 1 or 2 people, and if you don't have a driver,
Of course,
passenger.
you only need the front. Yeah.
But that also is meant to be like, before Robotaxi is ready, they're probably going to build that 2-person car, with a driver. So is that the Model 2? To your point, there's 3 million EV capacity. they're only producing, I think, 1.8 million cars. That's a lot of potential new car demand. I also saw some stat like 4680 production has increased quite a bit. And we've had a change in subsidies, by the way, in China. The cash flow clunkers, like the Tesla sales in the last few weeks have been very high. In Germany, I saw they reintroduced, like the European EV numbers were not so great, but they were disproportionately influenced by Germany. And now with German subsidies, we think that's, that's improving. But to your point on China's EV sales growing, there's this article about Jim Farley of Ford in the Wall Street Journal that came out today. And there are two charts here, which we're going to flash up here, that just talk about this electric vehicle share of all auto sales. So in the Chinese market in 2021, China and Europe had similar EV penetration at around 15%. China's EV penetration now is, nearly 40%. Okay, so that's, and actually, if you look back even in 2020, it was like at 6%, right? So they've really gone exponential, in China. And then if you look at that's within China, and then if you look at their exports, the value of electric vehicle exports from China is now like $35 billion. That's up from, like $3 billion in 2020, right? So that's grown 10 times. So I know this Dunn Insights has been, flashing this up, constantly. How the heck has
So that's
China
the interesting
been
thing
able to
is
do this so fast?
How would BYD just produce just under 400,000 cars in 2020, and now it's going to be 4 million this year?
Like
So
10 times increase in.
The ramping of production in China is just in a separate league.
And Elon and Tesla, like that factory in China was first, right? They gave them all the incentives to kind of come, but how did BYD and so many of the others be able to replicate that, so fast? And it's not all just replicating Tesla, but it's incredibly impressive. But it's an existential threat, I think.
The other thing that's been astounding, Howard, is if you've looked at how quickly NIO has set up battery swapping stations, which is another thing that they do that others don't do. So it seems like the other thing that I've always been impressed with China is if you look at the rate of growth of charging stations relative to EVs, they install chargers and they've preempted the rollout, whereas in some parts, including the US, I don't think they kept pace. It's obviously difficult because it's a big country, but China has hit everything on the head in terms of having everything aligned. So they've preempted this kind of rollout in the charging network, and they've got the production capacity also sorted out, and then scale to make it cheap.
Yeah.
I mean, you look at the quality of these cars, Howard, that's the other thing that I keep seeing feedback on YouTube and elsewhere is, okay, fine, they've ramped these up, but what are panel gaps like? What is the technology like in the cars and so on? And the feedback is very promising.
Right.
Europeans actually like Chinese EVs.
The politics of this is going to be just very interesting, how this unfolds. Like we all knew that they were going to be at risks, the incumbent, and it's only the really Hyundai, Kia, in America that seems to be doing reasonably well, from a U.S. market perspective. But China had a strategy. We've talked about it, Made in China 2025. That was not only that they wanted to kind of have a great car industry, but also they're overly reliant on oil. So they didn't want to have if they could have a non-oil based car industry, it has geopolitical ramifications for them. In America, like, we're not so worried about oil. We have enough oil, right? But are we, willing to lose, an auto industry, or like, are we just going to invest I don't know, the hybrids on the SE Insights webinar. They were arguing that this hybrid strategy, medium to long term, is not a great one because the maintenance costs is the worst of both worlds, right? The maintenance cost is going to be extra high. On the other hand, I had a good conversation with Lithium CEO friend of mine for a long time, and Ernie Ortiz, I think, at Lithium Royalty Corp, has done a lot of work on these extended range EVs, right? Which is, mainly battery, but it's a little bit of a petrol to charge the battery. I don't know. Do you have a thought on that topic?
Other than, it looks like the battery pack size on those is pretty decent, so it's not a sort of impairment. That the hybrids, and these hybrids have also, the pack sizes have also drifted out to be slightly bigger, so they're not what we think of as these lower plug-in hybrids. They actually have battery packs that are kind of matched to the small end of the pure EVs. So
yeah,
I mean, I understand what they're saying about the maintenance and so on, but again, Howard, as I said to you, we look at South Africa and other areas, they aren't ready for full EVs.
right.
So hybrids is kind of, a balance, but it is going to be interesting because, again, places like South Africa, they took in traditional OEMs. There's big plants, they're big employers, they make ICE vehicles. Unless they're prepared to switch those to EVs, I'm just not sure the size of the market's there. So it's going to cause this isn't going to be a smooth road. It's going to, upset people because that's a massive employer in certain parts of the country. And I'm sure in other economies as well, unless you can export from there, if you can manufacture like they do ICE vehicles in South Africa, if you can switch that to EVs and then export them, great. If not, so we still, the long and the short of it, I guess, how it is, it's the inevitable is when do, these OEMs get to, produce a broad range of competitively priced EVs so that they can stay in business.
Yeah. Well, do you think in Europe that they're going to be successful in slowing down the time frame for this carbon emissions?
Can VW, which is talking about for the first time in history closing plants in Germany, which has got the unions in a hell of a tiz, can they afford a penalty, a fine on top of that when they're losing money?
Right, and they're paying that to Tesla, right? I mean, is
Well,
that how it works?
They used to, but I mean, what the article that I read said that the cumulative fines, if things don't change, could be as much as 13 billion euro.
Wow.
So the auto industry, which is already on its knees and crippled, they can't afford that. At some point, again, I don't know how bureaucracy works here, but in Germany, if I'm not mistaken, the auto and auto-related sectors represent like 13% of the workforce. And Germany's industrial production has just done this because they've been losing to China. So industrial production's in free fall in Germany. Now, if you lose cars as well, and there have been articles about how many of the plants are underutilized. I think a full third of plants, are underutilized, car plants in Germany. Mm-hmm. So, this was always going to be a tricky one, but they knew it was coming. But, as you mentioned, and Michael Dunn, I think it was, who flagged it up about BYD going from 400,000 cars to like 4 million in 4 years. No one expected the China speed and the quality linked to that speed of their EV industry. It's caught everyone off guard. We came through this COVID period and they just coming out blazing. But it also,
I can't see the Germans just kind of just saying, okay, well, you win, and we'll find the company. I mean, I think you'll have a lot of German auto workers protesting in Brussels or wherever.
But they're protesting the closures. But here's the thing, though, is that the traditional OEMs aren't in favor of the penalties because they, of course, sell in China. So they don't want reprisals back. So this is it's a political hot potato. I'm not sure how it's going to pan, but I mean, simply put, the East and the West are going head to head now because people are losing jobs.
Yeah.
And, what we've seen is heavily debt fueled economic growth, certainly in the US and elsewhere. And, they can't really afford to lose it. I mean, I'm sure you see the numbers, the sort of low unemployment rate is a bit of a sort of, it's a smoke and mirrors because tons of people have got 2 jobs and whatever. So it's, as the world gets more efficient, we haven't even touched on, what it means for AI. We'll see what Trump and others have to say. What happens, when we all, aren't needed anymore. So it's a fast moving world. And if EVs are any indication, AI, I think, is going to, give us, some sleepless nights as well.
Okay. On that note, we've been at it over 50 minutes here. Yes, the world moves very fast. The velocity is what we've used as a term, for lithium, quite a bit. But it feels like, or at least I'm feeling a bit more optimistic than I have in a long time, that the bottom for lithium, might be in. Valuations are overall low. The world will need a lot of commodities, lithium and other commodities. And, Donald Trump said, he's even on the AI thing, recognizes how much electricity is going to be needed. He'll be all for drilling for natural gas in part to, support that electricity. But I think he'll be understanding, of all of the other, components as well. If he wins, Kamala Harris said, her values hasn't changed in her interview, on CNN, and she was supportive of the IRA, Inflation Reduction Act, timetables to, for the Green New Deal. So if it's Kamala, I think, on the Inflation Reduction Act and how that supports EVs and how that supports lithium, I think that'll be a continuation. I think, ex-China supply is going to be important for Europe and the US. So that thematic is very much intact no matter who's in power. And but just as IGO said, embrace the volatility. If you bought at the bottom or you're near the bottom in 2020, you had a great bull market, in lithium. We're close to the bottom. The prices can't get much lower. Obviously, we don't know how high they'll go once they do recover, but you can have no profits across the industry for an extended period of time. And, it's boom bust, as we've experienced in the 15 years of lithium that we're doing that. So, potentially invest accordingly. I know a lot of, I have still a lot of lithium shares I've held on for a long period of time. So it's a bit painful to think like, oh, okay, we'll just buy more. But if you've been watching us for a number of years and you haven't invested yet too much in lithium, now is actually a really good time to be examining companies like Arcadium that reputable investment banks are arguing very logically is trading at half of the replacement value. And there's not that many Arcadiums around, with world-class assets and customers and skills. So anyway, with that, Rodney, good talking to you on a Sunday. And to all our viewers, if you like this video, please like and subscribe, leave a comment, and follow us on X at Lithium-ion Bull, and Rodney Hooper is at Rodney Hooper 13. Look out for the next Lithium Bull, which is going to be coming out very shortly. And please register your email at rkequity.com if you want to receive these directly to your email box in the future. Take care.